This is Veriscope News. Verified news, clear context. Each report explains what is happening, why it matters, and how it fits into the larger economic picture. The focus is on facts, data, and structure. There is no commentary. There is no speculation. Today's report examines recent movements in oil prices. It explains how weather events, production disruptions, and supply management are shaping energy markets. Oil prices move daily. Short-term changes often reflect immediate events. Long-term trends reflect structure, capacity, and demand. Energy markets sit at the center of the global economy. Oil affects transportation, manufacturing, heating, and food supply chains. Changes in supply conditions can influence prices well beyond energy markets. Recent price movements follow a period of relative stability. Prices had already adjusted to slower global growth and steady supply expectations. Weather disruptions added new uncertainty to that balance. Oil prices were mixed in early Wednesday trading. Brent crude futures declined slightly. They fell by 6 cents or 0.1%. The price reached $67.51 per barrel. U.S. West Texas Intermediate crude edged higher. It rose by 4 cents or 0.1%. The price reached $62.43 per barrel. Both benchmarks had risen by about 3% the previous day. The immediate driver was a winter storm in the United States. The storm disrupted energy infrastructure over the weekend. It strained power grids and halted some production. Analysts and traders estimated that U.S. producers lost up to 2 million barrels per day. That amount represents roughly 15% of total U.S. crude output. At the same time, exports from the Gulf Coast were affected. Crude oil exports fell sharply. Liquefied natural gas exports also dropped. At one point, exports fell to zero, according to ship tracking data. Weather-related disruptions are not new to energy markets. Cold snaps, hurricanes, and heat waves have affected production before. In the United States, energy infrastructure spans large geographic areas. Production fields, pipelines, ports, and refineries must operate together. Disruptions in one area can slow the entire system. Over the past decade, U.S. crude production has grown significantly. Shale development increased output and reduced reliance on imports. As production expanded, export capacity also grew. The Gulf Coast became a key hub. Ports in the region handle crude and liquefied natural gas shipments. When weather shuts these ports, supply to global markets tightens temporarily. Outside the United States, supply conditions also matter. Kazakhstan is a major oil producer. Its Tengiz oil field is one of the largest in the region. A recent fire and power outage reduced output at the field. Recovery is gradual. By early February, less than half of normal production is expected to return. Meanwhile, pipeline operations in the Black Sea region faced maintenance issues. The operator of the CPC pipeline completed work at one mooring point. The terminal returned to full loading capacity. These events occur alongside broader supply management. OPEC and its partners coordinate output targets. This group, known as OPEC+, includes Russia and other major producers. For March, OPEC+ is expected to maintain its current policy. The group paused planned production increases. A formal decision is expected at a meeting scheduled for early February. This section explains how these developments affect different parts of the economy. Households. Energy prices influence household expenses. Fuel costs affect transportation and heating. Short-term price changes can appear at the pump or in utility bills. When supply disruptions are temporary, price effects often fade. Longer disruptions can keep prices elevated. Households feel the impact through higher energy spending. Prices. Oil is an input cost. It affects shipping, manufacturing, and agriculture. When oil prices rise, cost pressures can spread. In this case, price movements remain limited. Changes are measured in cents, not dollars. Markets are responding to known disruptions rather than unknown risks. Jobs and labor. Energy production supports employment. Shutdowns can pause work at fields, ports, and refineries. Once infrastructure recovers, activity usually resumes. Over the long term, stable supply supports job stability. Frequent disruptions increase uncertainty for workers and firms. Savings and investment. Energy price stability helps investors plan. Sharp swings increase risk. Recent price action suggests caution rather than panic. Markets are watching whether supply recovers quickly. Businesses. Businesses that rely on fuel face planning challenges. Airlines, shipping firms, and manufacturers monitor prices closely. Short disruptions can be absorbed between firms. Longer disruptions require cost adjustments or hedging strategies. Market participants are focused on several indicators. First, U.S. production recovery. Output levels after the storm will show how quickly infrastructure normalizes. Second, export flows from the Gulf Coast. Shipping data will indicate when crude and LNG exports resume fully. Third, inventory reports. U.S. crude, gasoline, and distillate stock levels provide insight into supply balance. Data comes from multiple sources. Official government reports are released weekly. Industry estimates also influence short-term trading. Fourth, OPEC Plus policy decisions. The group's February meeting will confirm output plans for March. This story explains why oil prices move even when demand does not change. Supply conditions matter. Weather events, maintenance, and policy decisions all play a role. Short-term price changes reflect immediate constraints. Longer-term trends depend on capacity and coordination. Understanding these factors helps interpret headlines. It shows how markets process information step by step. Oil market data is reported in layers. Spot prices reflect immediate trades. Futures prices reflect expectations. Inventory figures measure stocks at a specific point in time. Production figures measure output rates. Export data tracks shipments leaving ports. Each dataset updates on a different schedule. Markets adjust as new information arrives. This structure explains why prices can move modestly rather than sharply. Information is absorbed gradually. This has been Veriscope News. Verified news, clear context. Today's report explained how weather disruptions and supply management influenced oil prices. The focus was on facts, structure, and data. Thank you for listening.